Good day, fellow investors. My name is Sven Karlin and today I'll describe options. Many feel like options are too complicated or too risky for the part-time investors. I think that options can be used very well to increase your returns and lower your risks in specific situations. In this video, I'll describe what options are, and you can check how to use call options and put options in my other videos. An option is a privilege to buy or to sell a certain stock at a certain price in a determined period of time. In short, you can buy an option from a second party that guarantees you to buy a certain stock at a certain price in the next 6 months, or you can buy an option that guarantees you that you can sell the same stock at a certain price in the next 6 months, year, or even 2 years. So options allow for more certainty in investments. A call option gives the right, but not the obligation, to the holder to buy a certain stock at a certain strike price in a determined period of time. A put option gives the option to the holder, but not the obligation, to sell a certain stock at a certain strike price in a determined period of time. What we pay to buy an option, or what the seller receives when he sells an option, is called the option premium. And also what's very important to understand is that options are usually traded in contracts of 100 stocks. So you need to have a little bit of money to trade and deal with options. To keep it easy, I'll discuss options as options for one stock, but keep in mind that we always buy and sell contracts for 100 stocks. For example, this table shows Tesla's option chain for options that expire on November 17, 2017. Today it's June 6, so there are still 5 months left before the options expire. Column 1 shows the expiration date for both the call option and the put options. Column 2 shows the last price, or the so-called premium, paid for the specific option. Column 3 shows the last change in the price of the option from the previous trading day. Columns 4 and 5 show the bid and ask at the current moment. This is how much are investors offering to buy the option and how much are investors asking to sell an option. When you sell an option, people say you are writing an option, and when you buy an option, you are just buying a put or call option. The volume column tells us how many contracts have been traded on that single day, while the open interest column tells us how many contracts have been traded in the past and are still liquid, thus not exercised. The strike price tells us at what price can the option be exercised. For example, someone that buys a call option at the price of $49.22 has the right to buy a stock of Tesla at the price of $335 in the next 5 months. The one that is selling that option gets his $39.22 immediately, the option premium, but runs the risk of unlimited losses if Tesla's stock price goes up. On the put side, a person that buys a put has the right to sell a stock of Tesla at $335 while the person that sold the put gets the premium immediately but has to sell a stock of Tesla to the owner of the put if he so desires at the strike price of $335. The area that is in yellow means that the options are in the money. As Tesla's stock price is at $339.50 as I'm making this video, it is obvious that the holder of the 335 call option will buy the stock at 335 in order to sell it at 339.5, while the owner of the 340 put will certainly exercise his right to sell the stock at 340 because the stock price is a bit lower. To sum up, remember that options are contracts that allow you to buy or sell a certain stock at a certain strike price just for a determined period of time. If you want to know more about the risks and rewards of buying or selling calls focused on covered calls, or the risks or rewards of selling or buying puts, please click on my other two videos about options. If you have any questions, please leave a comment below and subscribe to my channel if you want to learn how to reach higher returns with lower risks. Have a great day and happy investing!